For this and a bunch of other reasons, I think gold is going to be very positive for the rest of the year. It will have its down days. It will even have some pullbacks. Gold has done very well. We've had a little bit of a pullback. There are pullbacks in many markets. I think this is a mid bull market cycle correction for gold. I think it's going to get stronger. The central banks are still buying lots of gold. You see a lot of gold things coming up in China. Check my last video last week for the last couple of videos for details on what's going on in the gold and silver trade over in Asia and in Russia. And we've got more news on that trade as well that we'll bring you towards the end of the week. But the big guys are demanding a lot of gold.
Global economic shifts and mounting sovereign debt are placing severe stress on traditional fiat currencies. Investors are increasingly turning toward hard assets as a reliable hedge against geopolitical instability and continuous currency debasement. Rob Kientz, a respected financial analyst and precious metals expert, argues that gold will perform exceptionally well throughout the remainder of the year despite minor market pullbacks. He predicts that this current consolidation is merely a mid-bull market cycle correction before prices surge higher. Looking further ahead, he projects that global and ground-proven reserves will face critical supply constraints between 2029 and 2030, leading to a severe long-term production deficit across major mines. Coupled with expectations that the Federal Reserve will maintain benchmark interest rates and historical seasonal demand warming up from late August through early March, he forecasts significant upside potential for precious metal investors. Now, we present the clips from Rob Kientz's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
For this and a bunch of other reasons, I think gold is going to be very positive for the rest of the year. It will have its down days. It will even have some pullbacks. You'll even see some people claim that the gold trade is dead because one day of economic data, something goes right. Manufacturing goes up. We have a good jobs month, something like that. People will say, well, gold trade's dead. Gold trade's dead. But I will remind you, a couple of 3 years ago, gold was trading at about 1,500, and now it's almost back up to 4,500. It's under that a little bit. And its all-time high in January was 5,500 in that range. So gold has done very well. We've had a little bit of a pullback. There are pullbacks in many markets. I think this is a mid bull market cycle correction for gold. I think it's going to get stronger. The central banks are still buying lots of gold. You see a lot of gold things coming up in China. Check my last video last week for the last couple of videos for details on what's going on in the gold and silver trade over in Asia and in Russia. And we've got more news on that trade as well that we'll bring you towards the end of the week. But the big guys are demanding a lot of gold. Prices going up. Gold's getting more scarce in terms of proven and probable reserves. Right about 2029 to 2030 is when we don't know how many reserves we're really going to have left in proven and probable. I mean, the highest quality of in-ground reserves that can be dug out through mining. So at some point in time around 2029, 2030, there's going to be a lot less gold produced in the world unless we can spin up more mines and find more gold across the world. So gold is becoming a little bit more scarce. This goes against the theory that people will tell you that there's a lot of gold available. Well, yeah, there's tons of gold, but when you compare that to dollars printed, bonds issued, values of economy, the value of gold is really understated because when you have currency resets or financial crashes, gold is what becomes the measuring stick for everything else. And I think in about mid 2024 is when gold started to become the measuring stick of the economy. It broke away from CPI inflation. It broke away from just about everything. Inflation protected securities tips, bond rates, everything. Gold just surged. And even though it's pulled back the first 6 months of this year after that surge from 2024 through the end of 2025, gold has still done very, very well. It's still beating the heck out of the stock market since 2000, most of the major indices. And so gold is a very healthy trade and has been going on now for almost 3 decades. And I think that people invest in gold are going to do very well. Overall, I think the gold trade's going to do well. Now, overall, the US dollar index has done fairly well this year. In fact, let's look at a year to date. It's up 1.61%, but in the last month, it's down over 1%. Pressure on the dollar for a bunch of reasons. I will do a video later in the week in which I talk about why the dollar index is going down. But for now, I just wanted you to note that the dollar is weaker when compared to other currencies. That's what the US dollar index measures, is it against 5 other currencies. And overall, because of some of the issues we see in energy, because of the rising rate of bonds, and because of what's going on in the Japanese economy, which again, I will cover later. This is the employment situation as we go to our second bullet point. July jobs down 23,000 K, 100K below expectations. We thought we were going to have an 80,000 positive print. This is straight from the BLS. Let me blow this up just a little bit for you guys. And on chart 2, I just want you to note that we're down again in July. Last time we were down was in February. So only the second down month of the year, but you can notice over the last year, we've had 5 down months at my count of jobs. And overall, the job situation is getting worse in the US. We're not creating as many jobs. The jobs we are creating are not as high quality. That's a deeper analysis into jobs, which I will do at some point. I do that periodically, and I'll do like a 3 or 4 month view on that. So we'll do that in an upcoming video. But just suffice it to say, with the jobs report being down, that has caused the gold price to go up because people are worried about the economy. And what happens when people are worried about the economy? They go to safety, and gold is one of those safety trades. And the ETF investment for both June and July has been very positive, almost 6 billion globally flowing into the ETFs after there were about 8.9 billion drawdowns the previous couple months before that. All right, I'm here on Kalshi, which is a way that you can trade the markets. This is not a sponsor, but I'm just using this as like an odds of whether the Federal Reserve is going to hike, hold steady, or drop their benchmark lending rate here in September in the coming month when they make an announcement. And you can see that for a long period of time, the Fed, the highest odds is about 75% as early as June, the end of May, actually. 75% that the Fed would maintain the rate, and that the hike percentage was very low over the last couple of months because of rising bond rates. This blue line, or the odds that we would have a hike, that the Fed would hike rates, had gone up. Now, however, given problems going on in the economy, several analysts are basically saying they don't think that the Fed is going to hike rates right now, that the chances of a rate cut or maintaining the rate may be the way it goes in September. We'll continue to watch that. But right now, if you add the Fed maintains rate or cuts the rates, which would be easing, which typically they do on signs of economic issues, it would be 57%, 56%, and hike is 44%. We'll have to see what goes on. I don't think personally the Fed wants to hike unless interest rates really spike, and I don't think they want to ease unless the economy's in big trouble. I'm guessing that they're going to keep the rate and maintain the rate for September, but we'll see. Why does that matter for gold? Because when interest rates go down, that's bullish for gold. And the long-term interest rates go up, that's also bullish, but it's more of a medium to long-term thing.
Macroeconomic indicators reveal growing vulnerability in the underlying labor market and foreign currency valuations. The recent United States employment report registered a decline of 23,000 jobs for July, falling 100,000 below expectations and marking the 5th down month over the past year. This ongoing weakness in job creation is driving market participants toward traditional defensive assets. Concurrently, the US dollar index has faced visible downward pressure, dropping over 1% in the past month despite remaining slightly positive year to date. In response to these economic headwinds, global exchange-traded funds recorded nearly $6 billion in net inflows throughout June and July, effectively reversing previous drawdowns. Meanwhile, central banks across Asia and Russia continue their aggressive accumulation of physical bullion reserves. Now, let's get back to the interview.
Here's the gold futures market as printed on CME Group, which oversees the futures markets here in the U.S., back in the Northeast. And you can see that open interest is at nearly 400,000 contracts. We've seen a nice steady increase in that dating back to late June. So in the last month and a half. And so people are starting to come back in the gold market. That's usually bullish for price. Remember, August is the first month. Typically at the end of summer, we tend to get more up months and down months. I think it's something like 56, 57% of the time it's an up month. And then really the golden era of gold prices, or the golden season every year, is from late August through the end of February, early March. So we're expecting gold prices just to go up because of seasonal trade factors, and that's normal. And so we're starting to see the interest in gold go up. If you look at the futures contracts, the dominant month right now, if you look at open interest, is December. This December 2026. I'll highlight the numbers for you. We're at 305,676 contracts. You've seen some people come in October that added 1,000 contracts. This is Friday dated because Monday data is not out at the time I'm doing the video. But October has a sizable contract position of 54,000. Now, you could see some pretty good physical deliveries in October because of this position, but really most of the deliveries would come in December. But don't sleep on October. We could see physical deliveries coming. As of Friday's data, we were up on the December contract $100 an ounce, and we're up more than that today. So gold is up again today. So we have had two positive gold days. Now, last week, technically gold settled down. It almost flatlined, but it settled down even with the Good Friday. So we're not at the point where I'm going to call a breakout on the gold price just yet, at least not from a technical perspective. But at least you can see here that we're having more open interest in the metals. Next, we're going to look at deliveries. This is the CME Group delivery reports, August 2026 so far on the COMEX. And as of Friday's data, the total of contracts standing for delivery is 15,416. If you add two zeros to that, you'll get about 1,000,005 ounces to be delivered this month so far. Now, we're still early in the month. Typically, you'll get the most deliveries in the first third to first half of the month. People stand for delivery right up front. You can do it as you can deliver your notice to stand for delivery or to take delivery the last 2 business days of the month preceding. So the last 2 days of July, people had already started. And you can see that here in 730 and 731, where you're standing for delivery in August. They give 2 days so that the people that have the gold on the other side of that contract, the shorts, they're going to be asked to deliver that, have some notice, and they can settle within 3 to 4 to 5 days, as is typical, at least according to the CME Group's website. But 15,000 is a fair amount of contracts to be delivered in August. August is a pretty good month price-wise for gold, but delivery month, this is a fairly good number, and it could get as high as 20, 25,000. We'll have to see what happens in the next week. I'm going to go to overall COMEX deliveries. This is on Gold Charts R Us. Thank you to Nick Laird for putting this website together. He pulls a bunch of data into his website, and we can get some time data where we can't get the same level of time data here on the COMEX. On deliveries, you can get up to a year. This is the monthly report. But on this, you can only get a few weeks, and then the data disappears. So what happens is Nick collects all that data, puts in some nice charts for us. And we're going to focus on gold deliveries. So right now, we're looking at gold deliveries for the last year. You can see that there are spikes every year. Usually at the end of the year, we have big spikes in the last few months of gold. That's been the trend until 2026, in which we had a big spike in the middle of the year, which isn't typical. Well, I'd say the spring and then the middle of the year. So we're seeing more overall gold deliveries this year, which is continuing a 2-year trend. Now we're going to look at a long-term chart. 2025 saw an astronomical amount of gold deliveries. This is just an absolute ton of gold deliveries, dating back to in 10 years. It's the highest amount in 2025 by far. In 2026, we haven't had the big single month spikes that you see on this chart, but we did have a consistent delivery of metals. What's happening is gold's being pulled off of COMEX. Stocks are coming down. I'll show you that on the next chart. And that's because the world is physically demanding gold. It's not just because prices are up, because prices were actually down. If you remember, from the big crash day on January 31st all the way through July, and even, into the first couple of days of August, it was sort of okay. But in the last few days of August, it's really started to come up. And it looks like gold's coming up in early August means we're going to have a very robust market. Kind of look at it like this. If you want to look at it like the Farmer's Almanac for gold, when you see gold start to rebound in deliveries and price in early August, it usually means you're going to have a good rest of year for gold. The last couple of quarters are going to be good. So I'm expecting gold to do fairly well this year. Of course, the fundamentals that I showed you, all of these things over here, are contributing to that, and there will be more contributing to that, and we'll continue to cover all of those factors, of which there are going to be very many and hard to cover in one video for gold to go up. Now I'm looking at the eligible and registered stocks of gold on the COMEX. This is what's left over. This is deliveries on a month-by-month basis. This is what's left over after the deliveries. You can see as of today, there are 26 million ounces. As of last week, there were 27 something million ounces. About less than a million ounces, I say 500 or 600,000 have come off in about the last week or so, according to the data that I have. Eligible is the stuff that's really sitting in warehouses. It's privately owned. It's not actually up for trading on the market. It's eligible to be, but it's not. Registered is where the gold holders say, okay, I want to put it on the futures market for potential delivery, and you move it out of eligible into registered. And when it's in registered, this dark green, that's where you can actually take delivery of that off of a contract. Anything ineligible, you can't take delivery until the owner of that says, okay, I want to put it up. There are a million reasons why that may happen. I won't cover that in this video, but that's just the way that the system works. So with gold trading in the 4,300s, we've seen a change of 227,000 ounces just in the last few days. It's been a really big change. And you can see the registered stocks are coming down. Now, there is still a robust amount of eligible stocks. You can see the trend is definitely down over the last year on a 1-year chart. Let's look at 10-year. The interesting thing about 2025, you can see 2025 down on our chart. So you come up during 2025, especially during the spring and a little, is where we peaked in gold stocks, both registered and eligible on the COMEX. And then immediately after that, after the early part of 2025, spring, a lot of delivery started, and we just had this precipitous drop. Now, we've had something similar between 2020 and 2020, about the third quarter of 2024, but that was more gradual. And that was because pandemic concerns, people wanted to take delivery of gold because of shut down the economy, but then a huge surge going into COMEX because of pricing and price arbitrage, and now that's being pulled back off. That's just the dynamics of physical. We're not about to run out of physical on the COMEX, but there's been an absolute huge drain. And if that drain continues, then we may not have the gold stocks that people want to be delivered.
Trading activity across major derivatives platforms reveals a significant structural tightening in physical bullion availability. On the CME Group COMEX exchange, total open interest has climbed steadily toward 400,000 contracts since late June, signaling expanded institutional participation in precious metals futures. December continues to serve as the dominant trading contract with over 305,000 open positions, while October maintains a sizable holding of 54,000 contracts. Physical delivery requests on the COMEX platform reached 15,416 contracts for August, representing approximately 1.5 million ounces of gold being claimed early in the delivery window. Consequently, total combined vault inventories have contracted from over 27 million ounces down to 26 million ounces in recent days. Registered stocks, the portion of vault inventory designated specifically for contract delivery, have faced a noticeable decline as international buyers pull physical metal directly out of exchange storage. This ongoing inventory reduction builds upon a multi-year movement of metal off paper exchanges, proving that global markets are actively demanding physical gold, regardless of short-term price fluctuations. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.